from a couple $100 million to several billion. So he's been a kind of a stalwart of our Dallas scene here, and we're really happy to have him. Next, we've got Aziz Gilani. He's with Mercury Fund, obviously out of Houston, but spends a ton of time in Dallas as well. He's been with them for almost a decade and focuses on investments in SaaS, cloud, and data science startups. Next, we've got Seth Harward. He's with Frontier Capital. They're out of Charlotte, but also spend a lot of time in North Texas. They're a growth equity firm focused exclusively on software and tech-enabled business service companies. And finally, Kevin Ainsworth with GuideCap. Kevin's an investment banker and has decades of experience in M&A transactions, valuations, and fairness opinions, and industry experience includes technology, business services, and healthcare. Shawn, maybe we'll just start on this end and let you share a little more about Teakwood and your all's focus, and kind of whatever you'd like to share, and then we'll get into a panel discussion. And obviously, this is meant to be interactive, so raise your hand, shout out your question, and hopefully we can kind of have a good discussion.
Thanks, Glenn. Thank you for having me. I appreciate it. So Teakwood Capital, you gave a high level, but let me give you all the buzzwords. You would call us a controlled growth private equity firm, and we focus on the micro cap end of the market, specifically on technology. So what that means is we're buying businesses that are like a lot of these other folks are, that are technology focused. So our key investment thesis is driving operational efficiencies for customers. So it's a B2B play where one company is driving operational efficiencies for another play, meaning in good times, customers will buy it because you drive revenue, and bad times, customers will buy it because you're reducing expense. We take a very heavy operational approach. So the firm's been around for over a decade, and we've learned from working with smaller companies the resources that are needed for these companies to survive and to succeed. And so we built an operational infrastructure internally where we've got internal executive recruiter, we've got an internal corporate general counsel, we've got business development, and we've got finance, and all these resources. They're a little bit like a SWAT team. If you guys remember the old Cisco Systems model, how they used to operate, where when we buy a company, when we evaluate and buy a company, they come in and they help make sure everything's in place that needs to be in place, figure out what needs to change and how we can assist them and get the ball rolling in that direction. Additionally, we bring in what are called executive partners. So these are typically former public company CEOs, and these are they're call it a day a week with the company, plus or minus, and they're helping them work on all the strategic and the tactical operational activities that need to happen for success. So that's effectively what we do and how we do it, and we're focused on Texas and contiguous states. So we believe in the long-term prospects of this corridor, and we're here to continue investing.
Hey, so I'm with Mercury Fund. We're a relatively early stage venture capital fund based out of Houston. We invest all up and down the middle of the U.S. We use a term to describe it. We call it the mid-continent. What that really means is that we invest in places like Chicago, Boulder, Ann Arbor, Cincinnati, and here in Dallas. In fact, Glenn serves with one of our portfolio companies here in Dallas, Coupon Media. We generally, we're on our third fund now, and part of the evolution of our fund is we started as a seed stage venture capital fund, but as the seed stage kind of got solved by local angel groups, we migrated a little bit upward along with our fund size, and so now we invest in companies post what we call product market fit. That means that these are companies that have repeatedly sold their product to enterprise type customers. Generally, we say about $1 million of annual recurring revenue is where we start, but there's always fuzziness around those definitions of what we call product market fit. But if you are hearing me refer to these enterprise type deals, that's because we only invest in enterprise software deals. We don't do consumer-facing startups. We don't invest in things that are primarily hardware. We really like enterprise B2B SaaS type companies, and it's something that all four of our partners are very focused on, and we enjoy building.
My name is Seth Harward. I'm with Frontier Capital. As Glenn mentioned, we are based out of Charlotte, North Carolina, but have been very active and would like to continue to be very active here in Dallas. The firm has been around for about 20 years, and really since the beginning has had an exclusive focus on B2B software and technical services companies. If you look at our portfolio today, you see that it's about 2/3 software as a service businesses across a wide variety of industries and verticals, and about a third are outsourced kind of managed services businesses that are leveraging some proprietary software to deliver that service in a little bit more efficient manner. From a stage perspective, we're focused on lower middle market businesses, which for us translates into companies that have somewhere between 8 to 10 million of revenue on the low end, up to about 30 million of revenue on the top end. These are all businesses leveraging highly recurring revenue-based business models at the end of the day that are doing well by most measures, growing kind of north of 25-30% typically, and that are looking to accelerate that growth rate. We will come in those situations either as a minority or a majority investor. We're relatively neutral on control, very focused on a certain type of business at a certain stage, and want to be able to do facilitate whatever the right transaction is for that company. Today we'll be announcing the next couple of weeks kind of final close on our fifth fund, which is going to be right at $700 million and have us writing anywhere from a $15 to $75, $80 million equity check into these businesses. We've had just 5 investments here locally, exited 2 of those and 3 active, and we're here on a regular basis trying to meet interesting companies and hopefully do some more deals here locally.
Hi, Kevin Ainsworth with GuideCap Partners. As Glenn said, we're an investment banking firm. It's all of a perspective that's a little later stage here. Much of the work we do is helping companies exit. We've been around for 17 years. Tech is our largest vertical. Probably half or more of what we do in any given year is tech related. And my background before was in Silicon Valley, so I have lived and worked for some time in kind of the ecosystem I think that we all aspire to help shape here. In terms of the types of clients that we really enjoy, and we work with a lot of tech companies, but really enjoy the companies that are innovators and have created something that's really differentiated and gives us the opportunity to really put together a process to sell a company not just based upon the financials, but based upon the strategic value that they can bring to the world.
All right, thanks everyone. Well, looking around the room and the invite list, when we kind of checked it out earlier this morning, we've got a lot of friends from out of town, so I thought that we would kind of start the discussion with maybe a primer of the North Texas tech scene writ large. Shawn, from your perspective, any subsectors, because we throw out tech, any subsectors within the technology vertical that you think that this area does particularly well, or that really kind of differentiates it from other geographies?
I'm seeing a lot in general here, but this is also nationally, so it's hard to differentiate between here and national. But what you're seeing a lot of is this whole Internet of Things that someone has mentioned, prescriptive analytics, artificial intelligence. So all of these technologies that are using data and that are using sensors and that are gathering data and that are analyzing it at a very fast speed to help make decisions for businesses and otherwise. You're seeing a lot of that. You see a lot of it in Austin, and you see some of it here in Dallas and Texas. And that's, in addition to the SaaS type businesses, you'll see a lot of that going forward. There are a lot of big companies right now that are battling it out, frankly, in that sphere. There's GE, for example, who's they've got a data analytics platform that scales across their entire organization. They're trying to have every vertical in the organization subscribe to it and use this to make their verticals in their company more effective and more functional. And IBM, everybody's heard what they're doing with Watson, and they're battling it out with GE, and there are other big public companies doing similar things. Cognizant, for example, is all over this. So I think that's a big wave that you'll see going forward, both here and in other places. But it's something that you definitely can't ignore, both if you're running a business and if you're investing in technology businesses.
Same question.
Yeah, so when I think about the Dallas ecosystem, what I think about are companies that are able to, and startups that are able to leverage, what you have in the form of a pretty concentrated customer base of large enterprises and a customer base of, let's call it CPG/retail. Part of the thesis behind us investing in Coupon Media here in Dallas was very much, the fact that they could point at local companies that they were able to win over very quickly to establish product market fit. So they were able to knock out folks like Michael's, 7-Eleven, Frito-Lay, relatively quickly in the company's lifespan because they were taking advantage of that concentration of customers that you have here. And so I think that that's the big asset that this market kind of brings to the table. And so seeing folks bring those novel IoT and data analytics technologies to that customer base is something that I think is very interesting.
I think the question was, what do you when you think of Dallas? What do you think of? Right. And I think if you heard, our pitches on our firms, what we focus on, the common theme was enterprise software, right? And we're all doing deals here locally, and I think we would all say that we think of Dallas as an enterprise software, enterprise solutions market. That's what keeps us coming back for more. You've got, I think, a good set of, large, kind of market-leading, business services and enterprise software providers here locally that kind of spin out folks who are of a like mindset. And so as a result, you've got some great, enterprise software, whether that's SaaS or IoT or whatever. It's all solutions that are largely being sold into enterprises that have that, drive operational efficiency and that are sticky and have good kind of unit economics there. And I think that's probably what brings us all here. It's the first thing I think of when I think of Dallas.
Ditto. Yeah. Seth, sticking with you on that, you got the microphone. Do you see that concentration or focus on the enterprise solutions driving the talent pool, or is the talent pool a result of, it's kind of a chicken or egg question there, I guess. How would you assess the local talent pool, and is it kind of concentrated?
That's all we do, right? And so it's great from my perspective. I think you've got the larger enterprises that have been here for a long time, and I think that's probably fed the ecosystem. So I think those companies have grown up here and helped generate some of that talent, and it's probably led to the talent pool that's here. So I would say they were probably here first and helped grow the talent pool. Our companies are a little bit later stage. We have not had a lot of trouble kind of attracting talent. I think when you raise institutional capital, that's one of the benefits. You're able to attract more talent because you've got a funder behind you and the resources to deploy there. So from our perspective and our seat, we haven't had any issue attracting talent to our companies, and we feel like there is a pretty good pool here locally.
Go for it. Yeah.
Dallas is much better than Austin. From a talent perspective and many perspectives. But the talent market in Austin is extremely painful, especially in certain disciplines. Data analysts, for example, software engineers, marketing executives, extremely tough to attract them. There's a lot more activity down there in a smaller environment. And as Seth said, there are bigger companies here that produce the talent that you can pull out of them. There's also still the vestiges of some of the other earlier stage investors that unfortunately are not here anymore. There are the companies that they backed, some of which are still alive and are still growing. And there are people that a number of us probably backed that are in companies that were successful and that were sold that have since spun out and started other companies, and they're still around. So there's some of that that's still lingering. That doesn't mean that the town needs more capital. It does. The town needs more capital over time to continue to drive these success stories and raise individuals who can start these new companies. So over time, we need to attract more capital to develop the people, the executives.
Do you think the lack of capital focused on this space is the largest impediment to growth of the North Texas technology?
I did a study, believe it or not, a long time ago with I did Boston, the Bay Area, and the Research Triangle of what's required to have a successful, I called it an entrepreneurial sphere. And it's capable people, so that's both people that come out of companies and educated people, and it's capital and it's successful companies. So we will need more successful companies that start up from a younger, from a smaller perspective or a smaller stage to drive the people who know how to start a business, who know how to build a business, and know how to exit a business. You have to have that for more startups to occur. So that's the gap that we need to fill over time.
Aziz, I think when we were speaking earlier, you talked a little bit about how the sources of capital have evolved over time as the ecosystem has grown up. And I know you all started as a much earlier stage, fund. What are you seeing over the past 10 years, and how has that evolved? And is it a good thing, a bad thing? Where are we going, in that evolution?
Yeah, so Mercury 1 and Mercury 2 were very much seed stage focused funds. So these were funds that would have invested these sub-$1 million checks. I think like the lowest check size we ever wrote was like $35,000. And those are investments that we wouldn't do anymore. And the reason why is because we were trying to solve for what we perceived was a problem with seed stage companies, so basically smart folks with an unfair reason to win in the market, trying to get their business off the ground. And in most of the markets that we participate in, that's a space that has been very thoroughly solved by well-organized angel groups now. Almost to the point of excess, where those valuations are actually, pretty heady, pretty frothy. I was looking at the numbers for the Austin market, and between 2006 and 2013, the number of seed stage investments had increased by 14 times, which is an absurd amount of growth, but it's consistent with what we've been seeing across this middle of the country type player. And so what you've seen is almost like a retrenchment in terms of the way institutional capital funds companies and the way that angels fund companies, and that you see many, many well-organized groups of angels basically taking on the responsibility of handling that seed stage side of the ecosystem, well beyond sometimes that $1 million mark that used to kind of draw the line and say, okay, this is where angels are, and then this is where institutionals start to play. And institutions that retrench for those higher levels. And frankly, that's affected us to the point where we don't really write term sheets for that sub-$1 million market anymore.
Seth, do you find that does that kind of jive with your experience? And would you rather find a company that has 1 or 2 sophisticated investors in it, or 20 kind of angels and do a little cat herding, but you're the first kind of professional in the deal?
2 questions here. So first question, are we seeing that trend kind of play out across the country? Yeah, we absolutely are. It seems like, we are focused on markets like Dallas, right? These kind of tier 2 markets from a capital perspective. While we're not necessarily just focused on kind of the middle of the country, we are spending the majority of our time outside of Silicon Valley, Boston, and New York. And we've seen angels, whether it be just individuals or organized groups, really step up and kind of fill the void of kind of where the venture guys were 10 years ago. And a lot of the venture guys that are still around doing deals have moved upstream. So that game has changed a little bit in these markets. So we're absolutely seeing that. As it relates to what is our preference? Our preference is for a quality asset at the end of the day. So whether that has 40 cats running around in it, we're more than happy to come in and help clean that up. One of the uses of our proceeds oftentimes is some liquidity to help kind of clean those folks out, give them their return, and kind of hit reset the clock for the company and have a kind of fresh pool of capital with a kind of engaged, value-added partner on the board. But certainly, welcome the opportunity to partner with businesses that have a little bit more sophistication as well. But at the end of the day, we're just looking for quality assets, regardless of how they've been, capitalized historically.
As we go through here, please raise your hand if you've got any questions for anybody on the panel. This is open, and hopefully you can hear somebody talk besides me. So let me know if anybody's got anything. Kevin, when we were, obviously the the end goal for all of this is the exit, right? I mean, the VCs are in this to make money. The angels have previously seeded this company to make money. They may have different, views on what is the right exit number. How do you, well, I guess two questions. What sort of multiples are you seeing, kind of the main sectors we've discussed today, and how are you managing those sometimes disparate expectations when you're going through an exit?
Yeah, and in terms of exiting in tech, you couldn't find a better environment. And I thought that this the multiple of the environment of high multiples is going to end every year for the last 5 or 6 years, and it hasn't. And so when part of me thinks of, when people ask me, I'm glad you asked the question, but when people ask the question, what are multiples? It's like, well, what does a house cost? It depends on if you're in Garland or if you're in Highland Park or wherever, it can matter. But if we're going to talk in generalities, maybe I'll just pick the enterprise sector that Seth and Pam talked about, niche enterprise software. The number one correlated variable for multiples is growth rates. And so if you look at the growth rates, you kind of stratify things, and you look at the lower end of the growth rates, it's kind of the 15 to 20% growth rates. You'll see multiples that private companies are getting, of 4 to 5x. And if you have shown a propensity to achieve those 50% growth rates with some visibility in the future, you can get the 10x's. And these aren't the more absurd unicorn valuations, but these are real valuations that private companies are getting. So also on the exit side, the truism 15 or 20 years ago was if you wanted to maximize value, you sell to a strategic, because there's going to be some sort of strategic value that you can extract. But we've routinely seen private equity firms be competitive in their pricing or even outbid strategics. And there's so much private equity money available that is causing a lot of competition. And it's also caused the private equity guys to become more innovative and ask, how can we add value? 10 years ago, if you were to look at the number of technology PE firms focused on the middle market, there have been a handful of really respectable ones. Now there are many. And so, if you can grow it, the environment's great, and the multiples are great. There's a lot of other things that you need. You need to be differentiated. You need to have a great management team. You need to, have the underlying fundamentals. But it's a good market.
With Dallas being home to so many of these larger strategics, I'm always surprised I don't see more activity out of them, in this space. Are you seeing, compared to other areas, they're, content to kind of do it internally?
We can get a term sheet from a quality private equity firm before a strategic can get an NDA signed. I'm exaggerating a bit, but it's true. A lot of these large companies have large company mentalities, and you have honorable people working there, but they're not really rewarded for taking risk, which could put their job on the line. And so, as a general rule, that's the case.
And as we talk about kind of finding these deals, that's always, I know, proprietary deal flow, and everybody kind of has their own little favorite hunting spots. At the risk of revealing too much, I'd like to go down the line and, how are you sourcing opportunities here in town, Shawn? Are they finding you? Are there any places that you go to, is it events like this? How do these companies find you, or vice versa?
It's all over the map. We do everything we can to try to get in the door with companies at an early stage before they're ready for us, frankly, and then you develop relationships over time. But a decent amount of it is from the roots we have at Austin Ventures. We've been investing in the area since the mid-90s, so for a long time. And so there are companies that we backed at Austin Ventures that have spun out people, and they've formed companies, and we've backed them since. Some of it's just from basic marketing, where people have heard about you, or a friend of a friend when they see an article about you in the newspaper. Some of it's more sophisticated marketing, because we're tech folks that we do online with SEO and SEM. And then we have a business development function, which I think everybody at every firm is in the business development game, and then most firms actually have a business development function that's focused specifically on how do we get our name out there and how do we find the deals and the companies that are interesting to us and fit our model, and also how do we communicate that, hey, we're good people that you would want to work with, so you should come and work with us.
Aziz, any secret sauce?
Man, finding a portfolio company is like finding your spouse. There's no structured way it happens. Sometimes you get introduced by a friend. Sometimes you meet on a website. I haven't really come up with like the exact formula to do it. We joke around the office. The fastest investment we've ever made was that coupon media investment here in Dallas. We actually went from first meeting to term sheet in 24 hours. So that's it on the quick side. On the slow side, though, we once took 2 years to make a decision to invest in a company. That was after we got tired of being introduced to the company so often. We just finally invested. There's no right answer to these questions other than, at some point in time, the firm, the timing is right. You're both looking for the same thing, and you both have the same goals, which gets me back to how you find your spouse. There's no right answer.
Aziz and I were laughing before we came in about the very topic, and my answer was just a lot of shoe leather, right? We're all out hustling, meeting with companies, and folks that are involved in the various ecosystems where we want to be doing deals. And I would say, from Frontier's perspective, we do tend to be relatively relationships oriented, and so 90-95% of the conversations that we're having are with companies that are doing something that's really interesting. They may be a little bit early for us today, or they may be right in our sweet spot, and it's just not actionable. They're not looking to do a transaction. It's not on the roadmap, but 12, 18, 24, 36 months down the road, that that initial coffee meeting or beer or lunch or whatever it was turns into a conversation about a deal, right? And what that might look like, and eventually translates into an investment. So where do our deals come from? There's no silver bullet, right? It comes from Kevin, it comes from another kind of service provider, another investor that's involved in the ecosystem. So that, any advice to give to the entrepreneurs would be surround yourself with good people, make sure you're, whether it's an investment banker or your attorney or your lender or your accountant, work with folks that are involved in the deal ecosystem, because those are good conduits for you to the right investors.
Yeah, I wish there were a magic bullet. I've been looking for it for 17 years now. It just takes a lot of work, like Seth said, a lot of shoe leather, and we find that some of the best the best clients and referrals really come from people within the network. The boards or individuals we work with, or attorneys or whatnot, because there's kind of a transferred trust and kind of a speed trust that happens versus going on a first date with a company and trying to figure out what's real and what's not.
Shawn, coming back to you, and I'd ask all the panelists the same question. Kind of take off your firm's hat for a second with your whatever the area is that you focus on. What technology or subsector are we talking about in 10 years that, right now you're seeing a lot of AI, a lot of cybersecurity. What is it 10 years from now?
I really don't know. I wish I could tell you, because I'd be in it right now, but everybody's excited about these. I'm going to take the contrary position. Everybody's excited about the self-driving cars and all this stuff, and I don't get it still. So I'll tell you what I don't think it is. I think the whole world thinks that's going to happen. I don't know. I don't see how you differentiate a squirrel from a kid, and I think there's a lot of issues there. So I wish I could predict the future and tell you. I think 2 or 3 years out, I share my ideas, but 10 years out, I don't know. No idea.
Yeah, I think that, so I'll take a contrarian point of view on what a lot of people say, which is a lot of folks seem to think that brick and mortar commerce transactions are going away, and I just don't see it. When I look at the marketplace in terms of like person-to-person commerce, It's not that brick and mortar is going away, it's just that the idea of like the big generic big box store is kind of going away. You're seeing, just like how our society is tending to barbell, I think that retailers are tending to barbell. So in the last quarter, if you look at like the most successful brick and mortar retail operations on earth, it's Apple on the high end and it's Dollar General on the low end. And both companies have never done better from a revenue or growth point of view in their history. It's the folks in the middle, it's like the Best Buys and the JCPenney's of the world who are suffering, or are kind of catering to that middle. And so what I think is you're going to see more and more personalized, demographic specific types of commerce engagement happening over the next few years. And you're going to see the products tend to match it. So you're going to see a barbelling of products to match the barbelling of product experiences. So more things like these $1,000 iPhone X's or like $40 super simple phones, and less of the middle type stuff. And I see that playing out across the economy.
I think commerce is a good answer, right? You've got some big winners right now, but everybody's going to have to change their game to stay relevant. And I don't think folks are just going to go away. So I think that's a good answer. I see security continuing to be a topic of conversation. There's trends, threats continue to evolve, and as a result, technology is going to have to continue to evolve to keep up with that. So that's not, that's not kind of news necessarily, but that's something I think we'll be still talking about in 10 years.
I mean, we've seen a lot of tech innovation in our lifetime, but in my opinion, there's really only been two massively transformative technologies. And one was the personal computer. There were thousands or hundreds of thousands of businesses that were developed around that. And then the second one was the internet. Some people might say the mobile phone, but I believe that's just a small computer and the internet combined. And I think we're going to see the third one in our lifetime, and I think it's going to be blockchain. And blockchain's a philosophy. There are going to be millions of companies that are developing the apps around it, which I believe is going to just really open up the world to a lot of new opportunities. A lot of the tech disintermediators used to have the cab unions, which Uber disintermediated. Blockchain apps are going to disintermediate the tech intermediators. And so if you don't know much about this, you should. And like I said, it's a philosophy, not a technology. And I'm not talking about Bitcoin, which is just one application built upon it. And if you want to learn more, there's a good TED Talk by a VC named Don Tapscott. If you Google TED Talks and blockchain and Tapscott, you'll probably find it. And you can kind of get a layman's understanding of what it is and the potential.
Well, I think we've got about 10 more minutes before we do our next group. Is that right?
Sure. You're right on.
Yeah, do we have any questions from the group? Oh, can I open up? Yeah, go ahead.
So what are you guys seeing in Series A in terms of preferences and board seats and things like that, structure of the deal?
Yeah, so that's a pretty typical transaction for us. Depending upon the company and number of co-investors, from a board seat point of view, we're seeing either 3 or 5. Man, if I can talk the entrepreneur and the previous investors into it, my strong preference is to go with 3. Just because at that early stage of a company's life, you want efficient decision making as fast as possible. But we've had 5. I think in one case we had 7, which was probably a bit heavy, and we immediately reverted that company actually down to 3 within 12 months. So from a board point of view, that's typically what we see at the Series A. What were the other parts of your question?
On the economic side of it, in terms of preferences, positions from the investor side, what are you guys typically seeing?
So we're pretty vanilla in our approach at Mercury. So vanilla in 2017, at least to me, is where as a lead investor, I want to see 20-something% of ownership. It's a 1x convertible preferred security that I'm taking. And I get the typical, Series A protections that get tied to the Series A director on the board. I don't know if I'm allowed to say this here, but I still think the Fenwick and West guys put together a great quarterly update on terms that you can download for free off their website. So I said,
steal it and read it.
yeah, yeah.
Not gonna hurt feelings.
Fenwick and Westcott?
Fenwick and West, they're a firm out of the West Coast. They literally survey BC, so I get their emails every quarter, and then they say, hey, what did you put on your last term sheet? And then you tell them, and then they put it in a survey, and then they send it all out to everyone.
Thank you.
So I'm probably asking a very typical question from someone like me. What percentage of your investments are women-owned, and are there any characteristics that are different about those companies?
I'll take it. Man, I wish I had more, but they keep on getting exited and sold for money. So most recently, I had Claire Bowe. She was the CEO at Experiment Engine, who was awesome. She sold the company over to Optimizely. Was a huge fan of hers. I count her on the list, but I don't know if this really counts. But we backed Nicole Galeros twice over at Techstars for different city funds that she helped organize for those folks. So we're a huge fan of hers as well. I don't know if I've seen like a characteristically different thing. I don't know. Like, so I just spent a few days up in Denver with Angela Tucci. She's the CEO over at Apto. Huge fan of hers as well. I mean, if you look at Nicole, Angela, and Claire, 3 completely different approaches to management, 3 completely different styles. I guess in my head I just see them as like our CEOs, but I don't know if I have a clean answer to that. Other than I think I see more of a generational thing. So Claire was very much a millennial, and Angela is very much like from the baby boomer generation, and she still writes memos and stuff, which are interesting to me. But that's all I got.
We have one run business in the portfolio today. It's done very well, but I can tell you it operates any differently than any of the other companies in our portfolio.
Almost a third of our companies have either been founded by a female or run by a female CEO, and it's same course and speed. Nothing's different. We don't change the way that we operate or the way that we think about it.
Portion of your investments are syndicated.
Just go down the line.
10% or fewer. We typically lead and sole fund our investments.
Yeah, I'd probably go 90%. So in contrast, we very much like to pair up with other funds that we think add value to the portfolio.
Yeah, I'm probably more in Shawn's camp. It's not, I think it has a little bit to do with the stage at which we all invest. Kind of later stage investors tend to write larger checks and larger pieces of the business. We certainly have partnered with other funds, and typically when we do, it's with funds that are already engaged in the business, right, and want to roll or kind of participate in the next round, in which we would come in and lead. And getting back to where you find a lot of our investments in these kind of tier 2 markets, where companies have been fairly undercapitalized. A lot of times they're angel-backed bootstrap businesses, right? So there hasn't been anybody in there. And in those cases, we're oftentimes coming in unless there's a strategic reason and just taking down the entire investment.
I'll give you a little perspective on that because I've spent a lot of time thinking about that over time. So there are different dynamics that you need to think about. So Seth's absolutely right. If you can bring in value-add partners, that can be very beneficial to you. They have ideas, they have thoughts, they have networks, they have people that they can bring in. On the flip side of that, there can be some challenges with bringing in investors. There are a lot of parallels to the question that was asked about the number of people on your board. How many people on your board? Well, how many investors do you have? You might have investors where every investor is on the board, or every investor might not be on the board. However, investors might have, if it's an earlier stage deal, they might have negotiated blocking rights or approval rights or negative covenants where you have to get their approval. So if you've got 10 investors, you got to go out to 10 different people to get approval for different things. I'll click down even a further level for you. So you've got one thing you would want to understand if you're going to bring in multiple investors is who is going to be on your board, your representative from your fund. Okay, and I'll tell you why that matters. There are people in funds who have been there a long time, who have a lot of stroke and a lot of sway within their firm and who can get things done. And there are going to be people in certain firms who need a win to look good in their firm and stay there, or else they might get booted out the door. And so there are people that are managing their careers within the fund. So that's one level. Click up another level. There are different firms that are in different funds. Okay, so you might have a fund that's at the very beginning of its life cycle, so it might stick with you 8 or 10 years. It just might. And there might be a firm that's at the end of its life cycle, so it needs quick liquidity. There might be a fund that's doing extremely well right now, and so if you get a 3 or 4x return for them, that's great. You might be in a fund that's doing really poorly, and you're the only hope they have of producing a good return. So it's binary to them. We're either going to lose it all, or we're going to make a 20x on this, and so they're going to be bullheaded and heads down and force you towards that 20x. So higher risk. So that's some context on around the dynamics that you're going to want to think about. But there's a lot going on under the covers there that probably isn't obvious if you haven't worked actually in a firm.
I think you guys need to be looking for alignment, just like we look for alignment, right? Whether it's with the CEO, founders, management team, or with other investors. I tell you, in Fund 1, which was it was a $45 million fund, we were doing like $1 to $3 million checks. We did do some syndicated deals. This was kind of late 90s, and got in some tough situations, right? And it's never a straight line to the exit. You've got 4 or 5 investor groups around the table with competing timelines and kind of decision-making criteria. Hard to get things done. So make sure you understand kind of who you're partnering with, what their motivations are. We want to know the same thing, right? Where's your head? What's your goal? Or are you all marching to the same beat here? Smaller kind of independent boards, which you tend to see in our companies.
We got a question, yeah, third row.
To what extent do you factor in the existing culture of the companies you're looking at, as opposed to the technology or the market opportunity?
I'll take it, but culture's been very important for us and kind of an indicator of success. And I think it gets back to alignment, and it gets back to kind of our relationships kind of based approach to investing. Are these folks that we can work with where there's a shared mentality around success and what that looks like? And a lot of times, a good culture is a driver of all that. So that's certainly something that we look for. And you walk into a good business, you can feel it, right? And you walk into a bad business, you can feel that too. So that's certainly, while market and technology are up there at the top of the list, culture is kind of right behind that.
If you've got a great culture, sell it. If you don't have a great culture, create it.
Yeah, we just hired a new analyst over at Mercury, and I was like, oh, let me give you like one of my textbooks from MBA school, and it was really old. It was Ruth Ann Quinlan's book, Secrets of a Venture Capitalist, and she talks about how there are 3 types of VCs in the world. She calls them horse, jockey, and racetrack investors. So the racetrack investors are folks who invest in certain types of markets. The horse investors are people who invest in like the technology, and then the jockey investors are the folks who invest in management teams. And I still think that what she says is right. She's like, it doesn't matter if you're which type of investor you say you are. That's probably the most important thing for you, but all 3 of them have to work. All 3 of them have to be awesome, because otherwise you wouldn't invest. You live in a world in which we can be, as VCs, we can be extremely selective. We are taught to be selective and say yes to all 3.
All right, well, I think that about does it. We're going to wrap up the panel and get into some of our companies' presentations. Once again, I'd like to thank the panelists. If I get a round of applause.